cost, normally we would say lower of NRV and cost. Above its historical cost would most likely be permitted if the inventory was held by a producer of agricultural products. It is A. In that case, when you're looking at goods that are commodity-like or commodities, you can hold it at NRV and take the gains and losses into the income statement. So that's acceptable. Financial statements were prepared using GAAP? No, not necessarily. I mean, this rule could still hold, but not always under US GAAP. The change resulted from a reversal of a previous write-down? No, that's available under IFRS, but only back up to cost. So it is A. Eric's Used Bookstore prepares its financial statements in accordance with IFRS. When we're thinking inventory, the big thing with IFRS under inventory is reversal of write-downs. Inventory was purchased for 1 million GBP and later marked down to 550. So it was at 1 million. Marked down to 550, so we had there a write-down of 450. One of the books, however, was later discovered to be a rare collectible item, and the inventory is now worth an estimated 3 million. There you go. Because it's IFRS, we are allowed a reversal. However, it will only come back up to cost. The inventory is most likely reported on the balance sheet at 1 million cost. Fernando's Pasta purchased inventory and later wrote it down. The current net realizable value is higher than the value when written down. Fernando's inventory balance will most likely be, and we're asked to compare IFRS and US GAAP. Well, US GAAP, no reversal. IFRS, you can reverse. So IFRS will have allowed Fernando to reverse it, reverse the write down and put it back up to cost. US GAAP, it will be languishing at the lower value. So it will be higher if it complies with IFRS. A write down of the value of inventory to its NRV will have a positive effect on the balance sheet. Well, no, let's think about this. An inventory write down decreases inventory and increases COGS. Writing down your assets is not a positive effect on the balance sheet. An increase in expense, not a positive effect on the income statement. Inventory turnover ratio. Well, the inventory turnover ratio is COGS divided by average inventory. If COGS is rising and average inventory is falling, this ratio will rise. That is a positive effect. It's gone up. Inventory turnover tells you how often do you turn your inventory over from the warehouse? How often do you sell it all? The higher it is, the more efficient it looks like your operations are. So an increase is a positive effect. Zimpt AG uses the FIFO method. And Nutmeg uses LIFO. It's a classic FIFO LIFO. Compared to the cost of replacing the inventory during periods of rising prices, our usual assumption prices are rising. The cost of sales reported by. So let's break this down. FIFO. We're going to do this a lot over the next 20 minutes or so. Looking at FIFO, rising prices, COGS, because it's first in, first out, is the old items, out of date, and in rising prices, cheap. LIFO, COGS is last in, first out, the new items, up to date, in rising prices, more expensive. So the cost of sales reported by Zimpt is too low. Zimpt is FIFO. It is A. Not Nutmeg. Nutmeg is not too low, it's up to date. Not too high. Yes, it's expensive, but it's up to date. It should equal the replacement cost. Zimpt AG uses the FIFO method. and Nutmeg uses LIFO. Compared to the cost of replacing the inventory during periods of rising prices, the ending inventory balance reported by. So Zimt is FIFO on the balance sheet. First in, first out, so the balance sheet is left with the newest stuff. It's up to date if prices are rising. It's the expensive stuff. Nutmeg LIFO. Last in, first out, so they're left with the old on the balance sheet. Out of date. And with rising prices, the cheap. So reported by Zimt is too high. Zimt has the new up to date, not too high, it's correct. Nutmeg is too low. On the balance sheet, it's the old, out of date, cheap stuff. Nutmeg is too low, not too high. Like many technology companies, TechnoTools operates in an environment of declining prices. Prices are falling. I would note that on my little sheet in the exam because when I see questions like this, I always assume prices are rising unless I'm told otherwise. Its reported profits will tend to be highest if it accounts for inventory using. So we're all about COGS here. Let's think about FIFO. FIFO is the first in, first out. It's the old. If it's the old in this scenario, it's the expensive because prices are falling. That means COGS will be higher and hence profit lower. We're looking for profits to be highest, so it's not FIFO, it is LIFO because it's the opposite to this. Weighted average is always in the middle, so it's not going to be weighted average. Compared to using the weighted average cost method to account for inventory, during a period when prices are generally rising, the current ratio of a company using the FIFO method. FIFO, first in, first out. So on the balance sheet, my inventory is first in, first out, so the inventory is now the newest. Up-to-date prices, and if prices are rising, the expensive stuff. Current ratio would most likely be, well, current assets are going to be higher because it's got more up-to-date prices than the weighted average. The current assets are higher, current liabilities are no different. Current ratio is going to be higher, it's B. Zimt AG wrote down the value of its inventory in 2017 and reversed the write-down in 2018. So in 2017, we'll have written it down and increased COGS. In 2018, reversed it, COGS reduced. Compared to the ratios that would have been calculated if the write-down had never occurred, Zims reported that the 2017, not sure about the grammar there, but I see what they're saying. We're focusing on 2017. Current ratio was too high. Well, back in 2017, current assets and current liabilities wrote it down by increasing COGS and decreasing current assets. So it wasn't too high, it was too low. Gross margin was too high. While in 2017, COGS got charged with the expense, so no, COGS higher will bring down your gross profit. Inventory turnover was too high. Inventory turnover is COGS. Over average inventory in 2017, COGS was higher. Average inventory was lower. Yes, that will increase that ratio. It's C. Zimt AG wrote down the value of its inventory in 2017 and reversed the write-down in 2018. So in 2017, COGS got hit. In 2018, it's reversed. COGS get reduced in 2017 on the balance sheet. Inventory was reduced and pops back up in 2018. The joy of IFRS. Compared to the results the company would have reported if the write-down had never occurred, Zimt reported that the 2018 profit was overstated. 2018, COGS gets reduced. Why? Because of this erroneous write-down. It should never have happened. And we're reversing it. By reversing it, you're reducing COGS, which increases your profit. You're basically stealing from earlier years. Profit is overstated in 2018. It's A. Cash flow from operations was overstated. Well, no. We're not talking cash flows here. We are talking profits. We're not changing the amount we spent on inventory. However, higher profits could mean higher taxes, so cash flow from operations could actually go down. See, year-end inventory balance was overstated. Looks tempting because you say, yeah, look, inventory's gone back up, but it went down initially. It is back to where it should be. If we wrote it down by 30, all we've done is credit that 30 back. So because the balance sheet shows you a position, we are back to the position we should be in. Because the income statement shows you your profit over a period, we have stolen some profit into 2018, so A is the correct answer. Compared to a company that uses the FIFO method during periods of rising prices, so we're back to normal rising prices, a company that uses the LIFO method will most likely appear more. LIFO in rising prices, last in, first out. COGS is the recent. Rising prices, that means expensive. That means rather COGS is higher. Profit is lower. Inventory is the opposite. Inventory is the old, the cheap. So inventory is lower. What have we got? Appear more liquid? A lower inventory, no. More efficient. Well, efficiency you can measure with inventory turnover, COGS divided by average inventory. COGS gone up, average inventory gone down. That ratio would go up. You would look a little bit more efficient. I can go for B. C, profitable? No, COGS is higher. You don't look more profitable. So answer is B. Nutmeg Inc. uses the LIFO method to account for inventory. The world of LIFO. During years in which inventory unit costs are generally rising, prices are rising, and in which the company purchases more inventory than it sells to customers, our usual assumption, its reported gross margin will most likely be. So we're comparing LIFO to FIFO. Gross margin, we're all about COGS. A last in, first out, which means COGS is the new items. If prices are rising, they're expensive. So COGS is higher, profit is lower. So gross margin would be lower than it would be under FIFO. Compared to using FIFO, or the FIFO method to account for inventory, during periods of rising prices, a company using LIFO is most likely to report higher. LIFO. Last in, first out. So COGS takes the newest items. If they are the newest items and prices are rising, they are expensive. So COGS is higher. Profit is lower. LIFO method, most likely to report higher net income. No, profit is lower. Higher COGS, absolutely. Higher income taxes, no, profit is lower. Don't get higher taxes from that. It is B. Carey Company reports under US GAAP. US GAAP allows LIFO, does not allow reversals. That's what jumps into my head. Well, let us continue. Whereas Jonathan Company reports under IFRS. IFRS, no LIFO, allows reversals. It is least likely, so we are talking here, least. Carey has reversed an inventory write-down. What does Carey do? Carey is US GAAP. It is least likely Carey has reversed an inventory write-down. I would agree, because they're not allowed. Not allowed. Let's check the others. Jonathan has reversed an inventory write-down, possibly. Jonathan's allowed under IFRS. Jonathan and Carey both use the FIFO inventory accounting method. Yeah, they might, because both are allowed. Answer is A. Now then, we have a lot of information here to plow through to answer a few questions, so we'll just try and pull up on each screen what's relevant. Here's the first question we're going to address. The cost least likely, to be included by the CFO as inventory. So we're talking about which costs are allowed in inventory. A, storage costs for the chocolate liquor. Storage is always a warning sign. Excise taxes paid to the government of Brazil for the cacao beans. Well, you can include that in cost. That's a cost of acquiring them. C, storage costs for chocolate and purchased finished goods awaiting shipment to customers. So storage appears twice there. If you look into the information and see what's going on here, it's a climate-controlled area. Finished products and purchased finished goods are stored prior to shipment to customers. That looks like this here. At that point, they are ready for sale. They're just waiting to go. They are not costs of getting your inventory into its current location and condition. So you can't include those. Storage costs for the chocolate liquor, that is a raw material. That is part of your production process. So if it's being stored throughout the production process, that is a cost of producing your output. So the storage we're looking for that can't be included is C. Here's our question. What is the most likely justification for Century Chocolate's choice of inventory valuation method for its purchased finished goods? What does it do for its purchased finished goods? We are told right down here, raw material inventories and purchased finished goods are accounted for using the FIFO method. So most likely justification for FIFO. A, it is the preferred method under IFRS. I don't think there's anything in IFRS really that says it prefers it. You could use FIFO, you could use weighted average, you could use specific identification. So I'm not going for A. It allocates the same per unit cost to both cost of sales and inventory. That would be true if we were talking weighted average. Ending inventory reflects the cost of goods purchased most recently. Yes, FIFO. First in, first out. So on the balance sheet, you have your most recent items. First ones go to COGS, most recent stay there. It is C. What's next? In Kern's comparative ratio analysis, the 2018 inventory turnover ratio to Century Chocolate. Inventory turnover ratio, we need COGS. And we shall divide that by average inventory. What year? 2018. 2018. We need COGS, sales and cost of sales. 41,043. Average inventory from the balance sheet. Inventories net, here we are. We have 8,100 and 7,039. We need the average of those two. That is 7,570. 7,570. That should give you 5.42. It is B. The most accurate statement regarding Anand's reasoning for requiring Kern to select a competitor that reports under IFRS for comparative purposes is that under US GAAP. So we haven't reprinted it here. It was just a lot of information. But Anand was saying, look, we need IFRS, not US GAAP. And the reason is that we report under IFRS, which means we use FIFO. What could the problem be with the US GAAP. Under US GAAP, fair values are used to value inventory. No, they are not. Nonsense. Under US GAAP, the LIFO method is permitted. Yep, they allow you to use LIFO. If that happened, your comparative would not be comparable. C, the specific identification method is permitted. Yep, it is in both. So not really a factor. Anand's statement regarding the perpetual and periodic inventory systems is most significant when which of the following costing systems is used? LIFO, FIFO, or specific identification. What is the statement? Here's Anand asked Kern why she has not indicated whether Century Chocolate uses a perpetual or a periodic inventory system. Kern replies that she learned that Century Chocolate uses a perpetual system, but did not include this information. Bad move, Kern. In her report, because inventory values would be the same under either a perpetual or inventory system. Anand tells Kern she is wrong. Anand is correct. Kern is wrong. Directs her to research the matter. Oof, cutting. She is wrong. When is it an issue? With LIFO. Specific identification, it wouldn't matter. Because every time you buy or sell a unit, you are identifying the specific unit. Makes no difference. If you're using FIFO, periodic, perpetual, FIFO will always come back to the same value. It's LIFO that gives you an issue. Let's just see why. Imagine you purchased 100 units at $7. Then you sold 20 units. You then purchased 50 units at $9. Then you sold 30 units. Now, if we're using periodic, we just wait till the end of the period and say, okay, 150 units, and we sold 50. How do we deal with that? Let's imagine it was the world of FIFO. If it's the world of FIFO, what happens? Let's say it's periodic. You would say, okay, over the whole period, I sold 50 units. We'll just work with COGS here. We could use inventory if we wanted, but let's do COGS. We sold 50 units. It will be the oldest, first in, first out. Oldest are 50 of those, so it would be 50 at 7. If we did it perpetual, every sale we track. So at this date, we'd say we sold 20. We go for the oldest, 20 of those oldest. Buy another 50, sold 30 here. We're always going for the oldest. So with FIFO, not a problem because we jump over this and go all the way back to the oldest. 30 of those. Identical, you're good. LIFO. If we use periodic for LIFO, 50 units, remember what LIFO says? It's the newest that go to COGS. So we'd say 50 were sold. Okay, there's 50. 50 at 9. If, however, it was perpetual, we have to update every time. So when we sold 20 units, we'd say 20 units. What's the newest? Well, these were the only units that existed at that date. 20 units at 7. 30 units at this date. The newest is now 30 of the 9s. It's not the same. It's LIFO. So, Kern, if you're watching, count that as research. Ignoring any tax effect. Hooray. The change in NRV of the black licorice jelly beans from 2017 to 2018 will most likely result in. We have disclosures here on black licorice jelly beans. Disgusting things. What's going on? Change in NRV. NRV was in 2017 to 2018, so going this way, was 395, went up to 420. Now, if you look at the balance sheet, on the balance sheet, inventory is valued at the lower of cost and NRV, so if NRV is above cost, it will be irrelevant. The NRV only finds its way to the income statement via revenue for a sale. So I'm expecting here, as we do, to see NRV below cost. Then it gets exciting. What did we have to do in 2017 for these units, we had to write them down by 10 cents because NRV fell below cost. It's a write down. Now, up to 2018, and we must point out we're in the world of IFRS here, so reversals are allowed. What happens? The NRV jumps back above cost. We can reverse. What we cannot do is write it all the way up to 420. All you do is reverse the write down. How many units are left at 405? Note it's the same cost, so we're just writing it back to that same cost. 77,750. We can reverse the 10 cents on all those units. 7775, it will be A. If the trend noted in the ICCO report, here's the ICCO report, continues, and Century Chocolate plans to maintain constant or increasing inventory quantities or usual assumption, most likely impact on Century Chocolate's financial statements related to its raw materials inventory will be. What's happening here? ICCO daily price, averaging prices in both futures and markets, reached a 29-year high. Prices are rising. Prices are rising. We are using, and from the information you would see that we are using FIFO, first in, first out. So the COGS number will take the oldest, first in, first out, which given this trend means the cheapest. On the balance sheet in inventory, we will keep the newest, which means the most expensive. So a higher proportion will be sat on inventory on the balance sheet as opposed to going into COGS. Answer has to be C, higher allocation of the total cost of goods available for sale, everything we spent, to ending inventory. The expensive stay in inventory. B is wrong. A, cost of sales that more closely reflects current values. No, because it's the old, out-of-date stuff. It's not A. We have here a lot of information on Crooks, Rolby, and Miko. What we've got is Robert Groff, an equity analyst, preparing a report on Crooks. As part of that report, we've got comparative financial analysis between Crooks and its competitors, Rolby and Miko. Crooks and Miko report under US GAAP and Rolby under IFRS. Crooks uses LIFO, Rolby FIFO, Miko LIFO. Groff gathers information on Crooks, Rolby, and Miko. Relevant financial information on the three companies is shown here. I have no idea where Exhibit 8 is. They've made that up. It's Exhibit 1. And we've got some more over here. We're told to compare the financial performance of the three companies. Groff decides to convert LIFO into FIFO. Going LIFO to FIFO, we're going to need the LIFO reserve. And adjust figures to assume no valuation allowance is recognized by any company, so we're trying to get consistency. What are we asked? Crooks' inventory turnover ratio. So for Crooks, we want the inventory turnover ratio. COGS divided by average inventory. Computed as of 31st December 18, after the adjustments suggested by Groff is closest to. Let's do COGS first because it's the numerator. 2018 will need COGS. So down to the income statement here for Crooks in 2018. COGS is 3,120. First of all, we need to convert that from LIFO to FIFO. Well, we'll deduct the change in the LIFO reserve. The change in the LIFO reserve tells you how much of that LIFO reserve has gone into the income statement. From 2017 to 2018, it's gone from 72 to 55, a drop of 17. So be careful here. You're taking out of costs a drop, COGS rather, a drop in the LIFO reserve. So that's actually going to be added. Assume no valuation allowance. Back to the bottom of Exhibit 1 down here. The write-downs allowed there were 13. We want to get rid of that. That'll leave us with an adjusted COGS of 3,124. Remember, negative here adds back. 17. That was because that LIFO reserve actually decreased. Inventory. We need the average. So from 2017 inventory 465. That was as reported under LIFO. To get to FIFO, we add the LIFO reserve at 17 was 72. 537 at 18. Gross was 480. We're ignoring the valuation allowance. Adding back LIFO reserve of 55. 535. The average of those two fairly clearly is 536. We will have an inventory turnover ratio of 3124 over 536. That's going to come to 5.83, which is B. What do we have here? Rolby's net profit margin for the year ended 31st of December 2018 after the adjustment suggested by Groff. Groff is suggesting here to compare the financial performance, convert LIFO to FIFO, and adjust to assume no valuation allowance. So Rolby, what have we got? Rolby is here. Well, Rolby already reports under FIFO, so this is irrelevant. All we need to worry about is the valuation allowance. Net margin, we will need our net income. Rolby has reported net income of 327. Already FIFO. No valuation allowance, so we'll add back this 15. But in this question, we are given an effective tax rate there of 30%. So given we have that effective tax rate, we should take account of the extra tax. So 1 minus 0.3 for that. Gives us 337.5. We wanted the net margin, so divide that by revenue. Revenue 5442. 6.2%, that is B. What do we have here? Compared with its unadjusted debt to equity ratio, so a very simple ratio, self-explanatory, debt over equity. MICO's debt to equity ratio as of 31st of December 2018, after the adjustment suggested by Groff, is lower, higher, or the same. What's Groff suggesting? To compare the financial performance of the three companies, Groff decides to convert LIFO to FIFO. We're looking at MICO. MICO is LIFO, so is going to get transformed. And adjust figures to assume no valuation allowance is recognized by any company. So we're going to ignore the valuation allowance and the charge to the income statement. Well, let's take each adjustment in turn. First of all, going from LIFO to FIFO, you would add back to retained earnings in equity the LIFO reserve after tax, if we have a tax rate, which we do. LIFO reserve in 2018, 77. That is going to increase equity. Secondly, the valuation allowance will be ignored, so we'll get rid of this 15. You get rid of that 15, net income for this year will increase, which will increase equity. We are not touching debt. The denominator is going up, which means this ratio is coming down. Debt to equity ratio is lower. It's A. Which company's gross profit margin would best reflect current costs of the industry? Crux, Rolby, or MICO? And we have the information on Crux, Rolby, and MICO here. So which company? We've got a LIFO, a FIFO, and a LIFO. Gross margin, current costs. Well, if I think LIFO, last in, first out, LIFO takes the newest items and sends them to COGS. So gross profit margin best reflects current costs if you're using LIFO, which Crux is. Rolby is not. Rolby gone. MICO is. So it's either A or C because they should be using LIFO. But we still have to narrow it down. What else can we look at? Well, turn your attention to the LIFO reserve up here. Crux. From 2017 to 2018, its LIFO reserve decreased. Crux, we can say, experienced a LIFO liquidation. If you have a LIFO liquidation, you release old costs into your income statement. So Crux potentially has very old costs going in, which means they're not going to be current. I'm going to rule out Crux. MECO experienced no such thing. MECO's LIFO reserve increased. No issues with this. It is C. What have we here? Would Rolby's valuation method show a higher gross profit margin than Crux's under an inflationary, a deflationary, or stable price scenario? What's Rolby's valuation method? They're talking FIFO as opposed to Crux, which is LIFO. So Rolby's method is FIFO. We are looking for a higher gross profit margin. Well, FIFO takes the oldest units to COGS. If we want a high gross profit margin, we want low COGS. That means we need prices to be rising, so the old is cheap. Prices rising, inflationary environment, it's B. Which group of ratios usually appears more favorable with an inventory write-down? What happens if you write down your inventory? Inventory decreases. Inventory is an asset, so assets go down, total and current. You charge an expense, it usually hits COGS in the income statement, so COGS goes up, and profits come down. So, group of ratios. Activity. We are looking at things like inventory turnover. COGS on the top, average inventory on the bottom. We said COGS would go up, average inventory comes down. It is A. If your numerator rises and your denominator falls, that ratio goes up. Which is more favorable? Your inventory turnover rises. It looks like you are turning your inventory over more often, selling your goods more quickly. It's a positive thing because the asset base came down. Solvency, nope. Profits coming down, so solvency isn't going to look better because that's going to hurt equity. Profitability, no again. Brand new set of information here to deal with a set of questions. I've just brought out what's relevant. What are we asked for here? The management discussion and analysis, MD&A, indicated that the prices of raw material, other production materials and parts increased, rising prices. Based on the inventory valuation methods described in Note 2, here's Note 2, which inventory classification would least accurately reflect current prices? Raw materials, finished goods, or work in progress. What are we told? Inventory is valued at cost, not in excess of market. Good. Cost is determined on an average cost basis. So we're using average cost, except for the cost of finished products carried by certain subsidiary companies, which is determined to be on a last in, first out basis. Okay. So raw materials, I'm going to presume are average. Work in progress, I'm going to presume is at average because the only exception I was told was finished goods, which was at LIFO. So that kind of gives the answer away, does it not? It must be B. LIFO, last in, first out. Well, you're taking the most recent last in and taking those to COGS and selling them. So inventory is the oldest. So your finished goods at LIFO reflects the oldest items. It has to be B. According to Exhibit 10, there is no Exhibit 10, the 2018 annual report, so we have extracted what we need here. If the company had used the FIFO inventory valuation method instead of LIFO, inventory valuation method for a portion of its inventory, the 2017 inventory value will be closest to. So we've got to adjust the 2017 inventory value. Here's 2017. Here's the inventory value. 608,572. We are adjusting, I assume, instead of LIFO. So we're going from LIFO to FIFO. How do you adjust inventory? If this is LIFO, how do I get to FIFO? I add in the LIFO reserve. So what am I told? Inventories cost, cost of finished products and subsidiaries, LIFO. Inventories valued on the LIFO basis, 94,578, 5817. Had the FIFO basis been used for those companies using the LIFO basis, inventories would have been, here we are. This is my LIFO reserve. Would have been 10,120 and 19,660 higher than reported at 17 and 18 respectively. I want 17, 18 respectively. So 17 is the first number. It's the 10,120. They told us it would be higher by 10,120, so you didn't even need to remember this. That comes to 618,692. That is C. If ZP had prepared its financial statement in accordance with IFRS, the inventory turnover ratio, COGS over average inventory, for 2018 would be lower, higher, or the same. Oh, good. So we don't need to do all the calcs here, which is pleasing. It's IFRS. They've used a little bit of LIFO in here. A little bit of LIFO. So if they use IFRS, it would have to go back to FIFO. Or weighted average or specific, but let's assume FIFO because we've got the details for that. What would the impact be? Well, COGS. How would I adjust COGS? I'd take COGS as reported using LIFO, and I would look for the change in the LIFO reserve. What's the change in the LIFO reserve? Do we have it? We have it here. Had the FIFO basis been used for these companies using LIFO, inventories would have been 10,120 and 19,660 higher to 17 and 18 respectively. So 17, it was 10,120, 18, 9,660. That is an increase in the LIFO reserve of 9,540. That means an extra 9,540 was charged to COGS because we used LIFO. It would have stayed on the balance sheet in inventory if it was FIFO. So to turn it to FIFO, I get to remove that increase from COGS. So COGS gets reduced. Average inventory at both 17 and 18, I get to add the LIFO reserve. So average inventory is going to increase. COGS in the numerator decreases. Average inventory in the denominator increases. This ratio decreases. The answer is A, lower. Quick one this. Inventory levels decreased from 17 to 18 for all of the following reasons except LIFO liquidation. In A, well, LIFO liquidation, we're told down here, had the FIFO basis been used for those companies using the LIFO basis, inventories would have been 10,120 and 19,660 in 17 and 18. The LIFO reserve increased. There was no LIFO liquidation. Decreased sales volume. We were told there was decreased sales volume. Fluctuations in foreign currency. We were told there were fluctuations in foreign currency. So we were literally told these were reasons. So you pretty much could have worked out it was going to be A. Not a great question. Which observation? Most likely a result of looking only at the information reported in Exhibit 10. There is no Exhibit 10. Note 9. This is the Note 9 that we have. So we are realistically dealing with this question by only giving you what it wants you to look at. Note 9. What can we